All right. What is up, tycoons? What's up, traders? Super excited for today's video. We're going to cover TLT as well as give you guys a good market update on what's been going on in the market. So make sure to smash that like button, subscribe to the channel if you guys are new. We can see that investors are still overweight in bonds. And this is increasing towards the great financial crisis levels. Okay. We'll take a look at that a little bit more in depth later. We are going to break down TLT's daily chart structure. If this chart looks a little complicated, don't worry. It's actually pretty simple, okay? I'm going to break it down for you guys very simply. We'll zoom in on the chart to take a look at the current setup that we have and where we could potentially be going. There's a pattern known as three white soldiers that we got here recently on the TLT daily time frame. We'll break that down for you guys. We'll also take a look at the forward PE ratios for the S&P 500 indexes. Or the S&P indexes. We'll take a look at the 500, 400, and 600. All right. Now, the stock market is being driven by the top 5 stocks. Okay. We'll dive into that a little bit more, why that's important. And we'll take a look, further in depth by taking a look at the percentage of S&P 500 stocks beating the index and what this could mean for the equal weight stock market, okay, for the equal weight index. And what that suggests, that maybe we could be seeing a rotation sometime soon in the future. We'll break down all of that and really just highlight, how big tech stocks have been driving the S&P 500's cap rate. And again, taking a look at the percentage of S&P 500 stocks beating the index. We'll also look at before and after the federal debt limit change and how that's affected the market since 1980 and since 1990. Then we'll go ahead and take a look at the pre-election year and aggregate cycles. All right. We'll also take a look at some warning signs that we're seeing for the market in the VIX, which is the volatility index. Some people like to call this the fear index. We'll dive into that a little bit deeper so you guys can understand what we're seeing. All right. And then, that's pretty much everything we'll cover in today's video. Okay. So as always, the content provided on this channel is for informational and educational purposes only and is not intended to be relied upon as legal and financial or investment advice. Trading in stocks, bonds, commodities, and crypto involve a significant risk of loss and is not suitable for all investors. So be sure to read through the full disclaimer. We'll go ahead and get into the video and start off here. Speaking how, what we're seeing is that fund managers are overweight in bonds right now. And this is increasing towards great financial crisis levels. Now, it's no surprise, all right, that this is happening due to the high treasury yields. Okay, so bonds are very attractive right now, and they're attractive to a lot of investors, whether it is, hedge funds, whether it is institutions, whether it is the retail trader. They have a lot of attention. I've covered this in many videos. We're seeing lots of money flowing into money market funds. And there's, it's very justifiable. Okay. I mean, why would you just have cash when you can get some very, very nice risk-free returns through, US treasuries and US bonds, right? So what's really interesting here is that, we're just really seeing it approaching those great financial crisis levels when a lot of people had lots of fear in the market. And meanwhile, the stock market has been rallying a lot heading into 2023. And we can see that we're actually increasing even more in, allocation to bonds when it comes to fund managers. Now, one reason for this may be the forward PE ratios, right? If we look at the forward PE ratios, the forward PE ratios are not very high right now. Okay. And so what we're seeing is we're seeing that not a lot of investors are investing into the market and driving up the PE ratio for the S&P 500. All right, that's our red line here. Then we have the 400, which is the mid caps, and we have the 600, which is the small caps. And we can see that those are even lower, right? So maybe it's time for a little bit of rotation, as usually these trade in very close unison and they're very far apart right now. Okay, if we look even more and just kind of, take a look right here on a smaller time scale, we can see, that these have been going down. Okay. Let me make this red real quick so you can see it. These have been going down and then these are still going up slightly. So, we are seeing a little bit of a divergence there. If we look forward, the S&P 500 is being driven by the top 5 stocks, and those top 5 stocks are Apple, Microsoft, Amazon, Nvidia, and Google. All right. We all know that Nvidia just made all-time highs. Apple is literally right by its all-time highs. It's only a couple dollars away from its all-time highs. What we have here is the white line, which is the mean return of the top 5 stocks, Apple, Microsoft, Amazon, Nvidia. We can see, really this has just been going parabolic. Meanwhile, the mean return of the remaining stocks is actually down. Okay, it's down right here since this peak in February. Meanwhile, the rest of the stocks, the top 5 stocks, have been actually accelerating a lot. All right. And you can see this more visually here in the percentage of S&P 500 stocks beating the index over the past trailing 3 months. And this is actually at extreme lows right now, right? Last time we were at these lows, we actually saw a big increase in the percentage of stocks beating the index when it comes to S&P 500 stocks. Now, the way that I interpret this is that it's very hard to beat the index, guys, unless you're literally focusing on the top 5 stocks. It's going to be hard to beat the S&P 500 index, right? And this is why index fund investing is so popular, especially because they are weighted by market cap. All right. Now, does this suggest that we could be seeing a rotation and it's time for the percentage of S&P 500 stocks to start, going back up? Yeah, it does, but does that have to happen? No, it doesn't really have to happen. Okay. There's no guarantees. The market's going to remain irrational longer than you guys can remain rational. So I know a lot of people have been trying to short some of these big 5, the top 5 companies in the S&P. A lot of people have been trying to invest in some other companies that seem undervalued, and then they're still continuing to drop, or different sectors that seem undervalued and they still continue to drop. You have to remember the market will always remain irrational longer than you can remain rational to pull you out of your positions and gain the liquidity that they need for their next move. That's what market makers are going to do. Now, if we move forward, we can see here it's been a very rough few months for the average. Okay, and so this is the equal rate slash market cap weight ratio, and we can see here that again we're reaching these levels here where it suggests that we could see the equal weight index start to actually rise, and this just suggests that we could see a rotation out of the top 5 stocks and into the other 495 stocks in the S&P 500. Right, pay attention to this critical line right here. You can see over here we start to see a move up. Over here we start to see a little bit of move up, then we continue lower, we hit this level again, and then that's when we really see a big move up. Over here again we see a pullback, big move up in the equal weights. All right, over here again, big move down. All right, we're below this line here and we see a big move up in the equal weights. Over here again, big move up in the equal weights, and now we're retesting this level. So could we potentially come down even lower? Yeah, we definitely can. Okay, but just going by some of this data, it does look like we're due for a rotation out of the top 5 stocks and back into some of the equal weights, into some of the other stocks in the market. Right, we can see that even more in this chart right here. If you look at the data right now at the current level that we're out, about 2 weeks later, okay, the median positive returns is about 3.8. 1 month later, it's at 4.5. 2 months later, it's at 1.3. So the next 2 weeks to 1 month do seem like they could be a good opportunity for equal weights. All right, and essentially saying that we could see a little bit of a rotation out of the big names that have been driving the market and a little bit more of a rotation into some of the other stocks in the stock market. Okay. Now, again, that's not guaranteed to happen, but the data does look pretty good from here. All right. If we move forward, all right, we can see again, big tech stocks are driving the S&P 500 capitalization rise. Right. We look at the equal weight index here in red, and it's just not keeping up with the market cap weighted index continuing to rise higher. Okay. So, it's really just, big tech stocks, and really ever since NVIDIA's boom, that's where we're seeing all of the attention right now is anything tech related, anything AI related. All right. And again, we can, just see that again here with the percentage of S&P 500 stocks beating the index over the trailing 3 months. We're at a very critical level right here now where we start to see, some of the other stocks in the market really start to catch up and perform. Now, will that happen again? That's for us to see in the future. We have a lot of catalysts coming up. Okay, we have CPI, then we're going to have the FOMC meeting. We're going to have possibly another Fed rate hike, maybe even a pause. We're still trying to determine that right now. All right, the CME watch tool for the Fed funds rate has been very, very volatile, guys. I mean, this thing went from below 10% all the way up to 50, 60%, then drop back down to 20, 30, 40%. That is all over the place right now. And it just gives you an idea that Nobody really knows what they're doing right now, guys. The only thing that they know is working for them is betting on big tech stocks, right? And that's just been what's working. I've mentioned it's been a very confusing market. I've been staying a lot, away from a lot of stocks and really trading the bond market because the bond market has been a little bit easier for me to understand. And you got to do what works for you, right? We had a lot of traders in the Discord get thousands of percent returns trading options on Nvidia, especially with earnings. And I've had a couple trades on Nvidia. I got like 150% on some options, but really for the most part, I've been focusing on the bond market. All right. If we take a look here at the S&P 500 performance before and after the federal debt limit change, this is really important because the debt ceiling is all that the news has been talking about right now. Okay, gone is the talks of inflation. Gone is really the talks of Fed rate hikes. It's all been about the debt ceiling. And if you take a look at the all-time performance after the debt limit change since 1950, all right. And you look at the trading days here, 60 days out, the market has been green. Okay. We've seen a very positive impact. Okay. Now, in the short term, all right, if you look since 1980 and since 1990 in blue and red, we can see that we do get a dip right after the S&P 500 or right after the debt limit change. All right. So, in the past, 40, 30 years, what we've actually seen is a sell the news type event, right? Where we see the market leading up into it. And then once we actually get the good news in recent times, we've actually seen a sell off and then we start to get the incline, right? But overall, 60 days after the debt ceiling announcement, we do see positive returns in the market. So you have to keep this in mind, right? Now, will it be driven by the top 5 companies in the stock market, or will it be driven by the other 495 stocks and we start to see a rebound in some of the equal weights? That's for you to decide. But remember, when we take a look at it, I tried to, emphasize the point that it's very hard to beat the indexes, right? Hedge funds, institutions, their whole bragging point is, oh, I was able to beat the stock market, the S&P 500 by 1%, or, oftentimes they underperform the S&P 500. And that's just a fact. So, if you're really stuck and confused, okay, dollar cost averaging in the index funds is, the best long-term investment strategy. And that's where you want to be, right? And when times are uncertain, you still buy, right? And when times are good, you still buy, and you just continue dollar cost averaging. And if you're more of a trader, this data is what's going to be good for you guys, right? I mean, knowing that 60 days out from now, since 1950, the stock market has gone up, right? And so, this is some of the data that's going to be useful to you as a trader. If you're a swing trader or a day trader, you're going to want to use some of this information to see if history is going to repeat itself. And possibly, if history repeats itself, we could see more gains in the stock market 60 days from now. All right. Now we'll move on to more and we'll take a look at some more interesting data right here, which is the pre-election year in aggregate cycle seasonal pattern. Now, what I really liked was the midterm election data, okay? Historically, 100% of the time, after a midterm election, the stock market has been green 6 months to a year out. And sure enough, we're having an amazing time, an amazing rally in the market since then. But if we take a look right here, returns start to average out a little bit, right? They do creep a little bit higher from this June to about September, October, November period. But really after November is when we start to see a parabolic rise through all of these, right? So, if we take a look at this data here, 60 days out, we're seeing increases in the stock market after the federal debt limit change. And then here we're seeing after November, we're seeing, increases in the stock market, right? And if we go ahead and use that 60-day time period, okay, we can see here that really, it's June right now. So let's just say all 30 days of June, all 30 days of July, we end up seeing these positive returns, guys. And you can see that, we could potentially be due for positive returns again in the market. And then in August, September, October, maybe things are a little bit more choppy and the path becomes more clear in towards Q4 of 2023. Now, again, these are just seasonal patterns, all right, and these are just historical data. History does not have to repeat itself, but as Albert Einstein has said, if you want to know the future, look into the past. Now let's move on to the next slide. And one warning sign that we could be having a pullback sometime soon, all right, is going to be the VIX. All right. We're seeing lots of money flying in to out of the money call options for the VIX. All right. The out of money put open interest on the VIX via CBOE. What do you think happened next? We're going to break down this chart a little bit larger on the next one, but that corresponding low that you see here was the mid-August 2022 and was swiftly followed by a 750-point SPX drop over the subsequent 6 weeks. Now, what's different from then and now is that time in August, all right, that summer 2022 was when Jerome Powell gave his famous Jackson Hole speech and really crashed the crap out of the market. I remember this vividly. I remember looking at financial conditions, saying that Jerome Powell is about to crash the market. And it was a very, very good time for me. I was shorting the market. I was shorting the S&P 500 via option contracts. And I got like 350% returns in a very short amount of time. So I remember that very, very vividly. But here, what we're going to be looking at is the out of the money put option open interest versus the VIX. Okay. And so we have the put open interest is extremely low right now, guys. We're not seeing, we're really seeing, very, very low amount of out of the money put options on the VIX. Okay. Now, put options are betting that the VIX is going to go down. Okay, that's what puts are. Those are options that bet the VIX is going to go down. All right, and then we see the actual VIX itself here. And the last time that we had out of the money put options this low, all right, we saw a very, very big spike in the market there. Okay, when it comes to out of the money put options, and we're back testing. It's actually below those levels right now. If you take a look. And again, times were different, but if this data wants to repeat itself, we could be due for a sharp drop in the market. And then you can see here, the VIX ended up going on a very big rise since that point. The VIX is actually lower. All right. Out of the money put option open interest is actually lower. And, we could potentially see a big rise in the market. Or could this be signs of a sentiment shift, right? Could this be signs that, hey, volatility is dropping lower. We really don't see the Fed going as aggressive anymore. We priced in, a lot of the bad stuff in 2023 and 2022. And now, they're looking for the next big real negative catalyst, and even bank collapses have not been enough really to drive this market down. All right, we'll move forward and go onto TLT and talk about the daily chart structure. Now, I did mention that for a very long time, we've been squeezing inside of this triangular pattern right here. We did get a breakdown. It looks very textbook of a breakdown, retest, continuation lower. People comment that I'm crazy, all this type of stuff. But guys, I'm just giving you guys some straight up technical analysis. Okay. I don't predict the markets. I can't say what's going to happen. All right. All I do is just try to prepare, and then I trade based off of some of the different technicals that we see. Right over here, I mentioned that we were having a double bottom form, and I mentioned that we are also getting a half gap fill. Okay. If you take a look, and I've mentioned this multiple times, when you fill half of a gap, that is a bullish signal. If it's a gap down and you only fill half of it, oftentimes that's a bullish signal. We got a bullish engulfing candlestick right here on top of a double bottom. And you can see we've actually put in now 3 white soldiers at these 3 candlesticks here, which is normally a bullish pattern. Okay. But we did end up getting a reversal candlestick here, followed by a very strong sell signal, or a bearish candle here. So maybe this, 3 white soldiers doesn't play out. That is a possibility. But I'm going to be looking to see if we can continue bouncing higher and potentially fill this gap up that we have here to fill. Okay. Towards that 104, 0.25 area. All right. That's going to be something I'm going to look for in the short term. Now, a little bit longer term. All right. And not super long term, but it does seem like we finally broke through this channel here. All right. And we could be getting a 1, 2, 3, 4, 5 down. And that's going to take us to fill this gap down here. Okay. We have this big gap down that I've been warning a lot of people of since we were trading in this range here. I said, hey, if we break this range, there's a strong possibility we could fill this gap down to, about 99. And we could even potentially fill this gap down here to 95. And look at where the 1, 2, 3, 4, 5 targets are going to take us, right? It's going to take us right to the top of that gap right over here. And if we hit the 1.0 extension, it's going to take us right to the bottom of that gap. So until we break through this structure here, and this is just a corrective wave, an ABC correction, and then we get a 1, 2, 3, 4, 5 up out of here. There is the possibility we could be getting a 1, 2, 3, 4, 5 down to fill this gap down that we have on TLT. Now, one thing that's pretty significant is we actually did get a nice MACD curl over right here, crossover, and this has been a good entry signal. So we got the bullish engulfing candlestick, then we had a MACD entry signal, and we can see we had a very strong push up from that $100 price level all the way up to almost 104 on the TLT daily time frame. Okay. And the MACD, if you're not familiar, all right, you want to use it for entry and exit signals based off this red line. When you see the red line curl above, that's been a good entry signal, right? And when you see it curl down below, that's been a good exit signal. And we had a lot of questions over here when TLT was looking like it was going to potentially cross back above. It actually rejected and continue heading lower. That's when we broke through our major trend line here. And for right now, this is a very textbook breakdown, retest, continuation lower. Now, could we come back up a little bit more, fill that gap for the retest to get the true retest and continue lower, then get our wave 5 targets? Yeah, for sure. But as I mentioned, we do have a little bit of a bullish candlestick pattern here, right? Which is the 1, 2, 3 white soldiers, right? If you take a look at the 3 white soldiers, this is what the 3 white soldiers is going to look like. Now, it's typically met with a little bit of consolidation or pullback, and then you continue that bullish trend, right? And you can see the same thing over here. This is 3 white soldiers, right? If we go back here to our TLT daily time frame, we can see we got 1, 2, 3 white soldiers, right? And, we did get a strong pullback here, which isn't the best sign. This looks like it could potentially be trying to form a reversal. But on the smaller time frames, TLT got very oversold today. So I wouldn't be surprised if we see some type of a bounce. Now, whether that bounce continues up to complete a larger wave 4, or maybe perhaps our wave 4 up is complete and now we're going to continue that wave 5 down. That's to be told, right? If we take a look here, again, we have that MACD crossover to the upside. We had this initial bullish divergence that we kept bouncing off of, right? We bounced off of it over here, saw a nice move up. We bounced off of over here, saw a nice move up, and we finally broke through that line. And rather than getting a breakthrough retest continuation lower, we could be in the signs or in the midst of a look below and fail, right? And this is going to be pretty significant and actually be a bullish sign if we get a bounce off of this daily bullish divergence trend line here. That could be another bullish sign here saying that, hey, we got to look below and fail. And actually, the reason that a look below and fail is significant is because right now at the breakdown and retest, this is the opportunity for bears to really show that they're in control and take advantage of the opportunity and push price lower. And what happened is the bears did not take advantage of that opportunity and the bulls actually pushed through there. So it kind of lets you know, hey, the bulls are actually in control of the price action right now, not the bears. So if we can bounce off of this bullish divergence trend line, that's going to be a good signal that, hey, the bulls are in control right now. Bears don't have control of the price action. But all of that is still yet to be determined. We really need to bounce off of this bullish divergence trend line and see a nice green day on TLT when it comes to Monday to look for the possibility of filling this gap up just above 104. Right? I remember I said about 104.25. Really, if things continue bullish, that's where I'm going to be looking for as a target. I have been long. All right. I do have long positions in TLT right now. I may have to cut those, okay, if things continue heading lower. But, we did have this 3 white soldiers here. We have seen a nice move up, and it'll be interesting to see if we can get that move up into the gap fill, right? Now, that could be wrong, okay? We could end up getting that wave 5 target to the downside sometime soon. We'll just have to wait and see how things play out. We can't predict the future, but all we can do is try to anticipate and prepare ourselves for different possible scenarios. Hopefully you guys enjoyed this video. If you did, smash that like button and subscribe to the channel. I do one-on-one coaching sessions all the time. So if you're interested in a coaching session, feel free to email me at zachleytrades@gmail.com. I'm booked up for this weekend and early through next week. But if you're interested, we can probably set something up for later in the week next week, maybe Thursday, Friday, or even next weekend. All right. So that's it. If you guys want to help support the channel, use some of the links in the pinned comment down below or in the description. And that will help support the channel and help support me.